Okay, so good morning, everyone. Welcome to the snapshot, the macro snapshot. We are Friday, March the 28th, 2025, recording this in the morning. Um, okay, so the first thing, let's just have a quick look at, we had a little bit of data yesterday, always just keeping an eye on what's going on with the US sort of economy, real economy, always just trying to balance this narrative of weak surveys versus relatively good sort of real data. And obviously the potential effects of the tariffs. We got the tariffs announced on car imports yesterday. So let's just have a look here and just see. We had the initial jobless claims in the US, and basically they came in yesterday at another low level. I think that from memory, the number was about 224,000 or something. But just to put it into context, you see this is 2025 in this sort of deep blue color here. And what you can see is that actually so far it sort of seems almost, if anything, to be going down, indicating a strong market. And you can see compared to the last, let's say, 8, 9, 10 years of data for this time of the year, we're doing very, very well. So no sign in the US labor market of structural weakness. And then if you look at the continuing claims, which is on the next chart here, uh, hold on, what's going on here? Oh, here's continuing claims here. You can see that that's still pretty solid as well, very much within sort of historical norms, not at all sort of accelerating, not at all, anything particularly to worry about. There's comments from sort of Elon Musk saying things that they're trying to, he's the Doge, he's hoping that within 130 days of his sort of a tenure, that they will be able to cut $1 trillion from the budget deficit. There was talk about 10,000 jobs being cut at, Department of Health and across various government agencies. So for sure, one of the only doubts about this sort of labor market data here is that, potentially we just haven't really seen the effects, and that people are sort of not yet actually laid off. There's some sort of legal issues. People maybe are sort of, claiming 2 or 3 months sort of redundancy payments. Who knows? So this, of course, could weaken as we go into the second quarter. But so far, this is holding up relatively well. And if we look at just sort of what's expected today, we have some other data coming out today. Obviously, the PCE data. Just before we look at some other stuff, this is a sort of this is the Fed's preferred sort of a gauge of inflation, of course. And what we can see is that if we look across all the banks, that the median forecast is for about 0.3 year over year. 2.5 is the median kind of forecast for the headline, and then the all important core down to 2 decimal points, 0.34 annualized at about 2.7. So the point is, this is not crazy. We're not talking 5 or 6 handles of inflation, but the point is that the Fed, we haven't been in the Fed's sort of preferred sort of range of around about 2% now for several years. So you have to say, at the minimum, Powell the other day thought that, tariff sort of inflation could be transitory. He used the dreaded transitory word, but the point remains that inflation still does remain a bit sticky. Let's call it somewhere about 2.5, 2.6, 2.7. And there is a perception that with the tariffs coming on, that could definitely raise prices, at least for autos and maybe second-hand cars as well, for auto parts, cause some unemployment. We'll see what's going to be happening. We had yesterday, for example, Ferrari, which is obviously in the luxury segment, but talking about raising immediately 10% of their prices. So it looks as though, this inflationary thing here, at the very minimum, we could say that 2.7 doesn't look like it's going down to 2% anytime soon. And if anything, the risks are to the upside, maybe even up towards a 3 handle. Just talking about cars and tariffs, there's been a range of reactions to all of that. We have Carney from the incumbent Prime Minister of Canada talking with Trump today. He was talking pretty tough yesterday about Canada wanting to sort of stay firm and retaliate. Keep in mind that Carney is in the middle of an election cycle. There is an election campaign, which is the elections happening in 1 month on April the 28th. So, it's probably behoven of him to sort of speak tough. But nonetheless, this could be a very serious hit to the Canadian economy. And just to put that into context, just got a little chart here about car exports. So, for example, you see here that over 90% of Canada's passenger car and truck and truck exports go to the US. And you see that in terms of sort of dollar worth for the Canadian economy. We're talking about 50 billion Canadian dollars, so very significant for an economy the size of Canada. So definitely sort of some sort of pressure there. So just looking back at a couple of things, just again, just want to look at the PCE numbers here, as well as the PCE numbers this morning, which, as you say, expected at 0.3 for the sort of the core number here, 0.3, 2.7 year over year. But what's going to be interesting as well, at the same time, we get personal income and personal spending. And again, just trying to get a sense of whether, incomes are stable, rising, and whether people, the consumers in the US are actually continuing to spend. So that's the focus of that. And definitely, if you look at the way that the market's been sort of acting recently, the market is not taking, let's say, for example, we look at something like the US dollar, a lot of the sort of the commentary and the narrative going into the tariffs was that this would be strong for the US dollar, inflationary, et cetera, et cetera. But what we've actually seen is that the US dollar, just on the news yesterday, sort of underperformed a little bit, if anything, and is sort of grinding high, but not really sort of showing massive outperformance. And this, I think, and then if you look at something like the euro, let's look at the euro on the spot price here, which is here, we can see that the euro is also not absolutely collapsing. So it's not as though all of the other currencies are ripping against the US dollar and the US dollar is collapsing. It's simply that this is a complex situation, and the market, it seems, is looking at the tariff announcements with a little bit of confusion, because obviously we don't know exactly what's going to happen on April the 2nd. There's also a thought that Trump could sort of compromise, do deals, horse trade, et cetera, and that's one of the reasons why it's going to be interesting today, the conversation between Carney of Canada and Trump, just to see like what's sort of almost like what's the reaction function of the White House. Are they prepared to deal April the 2nd next week? Are they going to go in with a sort of a maximalist position? If you want to sort of negotiate, you go in with a sort of a high number, but with the intention of bringing it down. That seems to be a little bit what the market's thinking about here. But the market does seem to be sort of taking overall, in my opinion, more focusing not so much on sort of increased growths and increased income for the U.S. Treasury, but more sort of increased tariffs and potentially sort of a hit to growth, not only in the U.S. But in the all across the globe. And if we actually look at just a couple of the stock markets here, before I get back to some of those markets here, some of those other charts here, if you look at something like in Korea, and I was pointing out yesterday. Look at the Korean Kospi, which is in the black here, which is down a lot, since February the 25th, down to 2.6% here. And then on Friday, just 1.8% as well. So the Kospi in Korea down a lot. And obviously, they've got big manufacturers there like Kia, Hyundai, who adversely affected. Also, the Nikkei down quite a lot. So some of the Asian markets really sort of under pressure, at least at this point. And so, again, just in terms of this narrative of of tariffs being potentially inflationary and sort of a drag on growth. I mean, let's look at also just how some of the yield curves have performed here. So let's say, for example, looking at the 2-year yield in the US, you can see that at the front end here, the 2-year yield, hasn't moved a lot down, if anything. Then you look at the 5, the 10. And the 30s. So you can see that, as there's still a little bit of a sort of steepening basically going up in the curves. And you can also see over in Germany, something like the 2s, 10s, you see how that's remained pretty steep. And of course, there's a lot of sort of spending pressures there as well. But generally what we're seeing is a sort of a steepening around the world of yield curves. And that could be a combination of fiscal sort of stimulus in the case of sort of Europe and Germany, or specifically Germany, and let's say in China, but also in the US, just a bit more of a sort of an inflation scare. The idea is being that the Fed is going to be pretty much anchored, but that the yields could need to rise just because of sort of inflationary pressures. And if you look at something like the stocks, let's look at the ES or just on the futures here, you see again. This is the continuous contract, but you see it was rejected at the 200-day exponential moving average here on on the June contract, and you see this is the 50-day moving average, so still very much below the 50-day moving average, below the 200-day exponential moving average on the front contract. And basically, yesterday, indecision day, and sort of just a little bit soft this morning. Same thing for the Russell. We also see over in Europe, if we look at, let's say, the German, the DAX, just sort of coming off highs. We also see the Euro Stoxx 50 coming off highs. And if we look at something like the Euro Stoxx 60 also sort of trading along sort of recent lows. So all across Europe and across Asia and across the States, there is definitely like a risk off kind of sentiment, and quite a lot of churn and quite a lot of chop, just waiting on the specifics, but definitely a risk on sentiment. And if inflation today with the core PCE does come in towards, let's say, well, it's expected to be 0.3, but let's say we get a 0.4, that could really cause a little bit more sort of concern as well. And the concern here is that the Fed, let's say in the last 10 years, anytime there was some kind of economic downturn or some kind of risk event, the Fed, because of the low levels of inflation, could come in and actually sort of cut interest rates. But that's going to be a lot more difficult this time with this sticky level of interest rates. So it's got the idea here being that the Fed may not be able to ride to the rescue at all. And that's been reflected, all of some of this sort of, geopolitical risk, sort of economic uncertainty, inflation risk, and of course the instrument par excellence. And I won't bore you, but no doubt everyone's seen this, but just look at the gold. Gold was, essentially had a tiny, tiny little sort of dip for 2 or 3 days, and it's now pushing even above this sort of longer term sort of up channel trend. And we're now, what are we at? $3,075 approximately. Silver as well, doing very, very well. That seems to have broken out. But again, just keep in mind that some of this, maybe not so much for gold. We've explored that. There's a lot of sort of charts going around at the moment, just talking about central bank demand remains very, very strong in places like China, geopolitical risk, silver and copper as well. There is also a little bit of an element of trying to front run the tariffs, but it does seem that the potential tariffs, it does seem that the window for that, especially in copper. If you look at copper here, as I say, kind of poked its head above that sort of recent high at about $5.20 per pound in the US. But as I say, if you look at the Fibonacci extension here, it's getting very, very oversold. And in fact, what we've seen in the last 36 hours is copper just coming back down a little bit. So it's going to be interesting to see just how much of this was sort of some kind of arbitrage play, and whether the window for that arbitrage between, let's say, London copper and COMEX here is going to change. Because at this point, if that sort of tariff does come on and the window for the arbitrage trade here does kind of close, then we might get back to more sort of fundamental questions of global demand. And although, of course, the medium and long-term prognosis is very strong for copper demand, the shorter term is that there could be sort of a risk-off sentiment in terms of global trade and global demand. So interesting to see here if copper falls significantly or whether it just continues to grind upwards. In terms of other things today, we got overnight just a bit of inflation data, and there's sort of conflicting stories here. If we go over to Japan, we can see US dollar here just coming off just a little bit here against the Japanese yen. Not a huge amount, just because overnight we got the Tokyo CPI, which was a little bit higher than expected. I think actually I pulled a chart of that as well, just to put that into context. Do we have the Tokyo? Yeah, I think that's here. Yes, you see the Tokyo CPI, and you can see here that that's remaining pretty sticky, sort of around about the the actual is 2.9, almost up towards 3, a bit higher than expected, which is 2.7. Also, if you look at the core number here, excluding fresh food and energy, you see that that's also sort of pushing upwards, and that's important because the Tokyo CPI, obviously, Tokyo is a sort of a megalopolis, an agglomeration. And that is considered a proxy, like a sort of a precursor to the overall sort of levels of inflation across Japan. And we can see that the Japanese sort of central bank, the Bank of Japan, the BOJ, of course. If we just look at what's sort of being priced into markets here, where's the JOE? We can see that the market is pricing in, one full cut. Let's say 25 basis points of hikes, rather. Sorry, I beg your pardon, of hikes by the middle of September meeting. So nothing much really expected for the middle of May. But the point is, as long as we continue to see sort of CPI grinding up towards and maybe even above the 3% level, that should encourage speculators to believe that this pricing, let's say maybe even for June, at 14 basis points, that could go up a little bit, and maybe even for the July meeting, maybe that's the one which could be priced up to 25 basis points, and that would indicate potentially at least, that the BOJ is on track to hike, once, maybe even twice this year. And what does that mean in terms of the trade here? It could mean that the US dollar weakens a little bit here against the Japanese yen. We could see a yen, going below 150 down to 149, or who knows, even testing the 146 level. On the other hand, we got overnight the CPI numbers for France and Spain, which came in a little lower than expected. So we're getting higher in inflation potentially in the US and in Japan, but we're getting a lower inflation potentially in the Eurozone. So if we look at the euro, we can see here that the euro, not doing a huge amount because, again, it's caught between this whole idea of what the ECB is doing and the real economy and the stimulus sort of spending in infrastructure and defense in Germany. And of course, this huge danger next week of potentially tariffs coming in, maybe messy and not as bad as expected, or maybe actually quite aggressive and consistent. We shall see. But just in terms of pricing for the ECB, at least one thing the ECB can sort of point to is that inflation does seem to be moderating slightly, not as sticky as the US. And if we look at pricing here, overnight interest rate swaps for the Eurozone, we can see that the market for the next meeting, which is basically coming up in about 2 or 3 weeks on the 17th of April, still pricing in an 86% chance of a cut. So we've got almost 22 basis points out of 25 now priced. And if we go out towards the end of the year, similar to the US, about 2.5 cuts are priced in. So the market's still pricing in an ECB, which will be easing. Again, the effective rate, the overnight rate is still much below the US, but the market's still pricing that to be around about 2% by the end of the year, and that's going to be dependent, of course, on on this very complex interplay of the tariffs and the real economy, and of course you throw in inflation. So pretty complicated mix there. Okay, guys. So I'm going to leave it there because I want to get prepared for the core PCE again. The market is pricing in, a relatively sticky core PC of 0.3. So I think 0.3 would be completely expected. 0.2 would be, of course, a positive surprise. 0.4 would be a sort of a nasty shock, which is going to affect sort of the front end. But I think what seems to be happening at the moment, there is a sort of asymmetrical sort of feeling that the Fed will not, the bar for the Fed to hike is very, very high. So 0.4, yes, that would cause a sell-off in the front end, but I think also that would hit the belly and let's say the 10 and the 30 year quite badly as well. This idea that inflation is remaining sticky and is a problem, and the Fed is not really at this point prepared to hike to batten down inflation. And of course, we have the tariffs coming in. Okay, I'll leave it there. Have a good day, have a great weekend, and we'll continue the conversation next week. Thank you.